Between 1914 and 1929, the global economy underwent a massive industrial expansion. Production hit record levels, technological innovations entered the home, and stock market valuations climbed with every passing month. To many, it appeared that a new era of permanent growth had arrived. This data tells two conflicting stories. On the left, the Dow peaks at 381 points, while auto production clears 5 million. On the right, by 1933, U.S. GDP drops 30%, unemployment hits 25%, and 9,000 banks vanish. How did the world's primary industrial and financial power lose half its output and a quarter of its workforce in just 48 months? While popular history centers the narrative on the October 1929 stock market crash, the reality of the collapse is found elsewhere. The October crash acted as a catalyst, stripping back superficial prosperity to expose the structural rot that had accumulated for a decade. The 1920s economy functioned as a series of over-leveraged subsystems, each designed in a way that made a broad systemic failure inevitable. To understand the eventual collapse, we have to evaluate the mechanics of the 1920s boom and see where the system was under the most pressure. The first critical subsystem was global capital flow. World War I exhausted the economies of Europe, forcing a shift in global leadership. The United States transitioned from a debtor nation to the world's dominant creditor and financial center. The resulting debt cycle looked like this. American banks routed loans to Germany. Germany used those funds to pay war reparations to Britain and France. Britain and France then routed those same payments back to the United States to settle their own war debts. This node-based system contained a massive single point of failure. The entire cycle relied on a continuous outward flow of capital from American banks. If American credit stopped, the mechanism would seize. Germany would default, the Allies would be unable to repay the U.S., and the international trade system would lock up. Throughout the mid-1920s, the sheer volume of U.S. lending obscured this fragility, creating a sense of European recovery that had no internal foundation. The international financial order was not built on organic wealth creation, but on a circular flow of debt that required American lending to remain wide open. Within the United States, a different structural flaw emerged. Techniques like Fordism and the moving assembly line allowed factories to increase standardized output exponentially, cutting the time to build a Model T from over 12 hours to just 90 minutes. But these gains were distributed unevenly. While corporate profits soared and high-income households saw large gains, wage growth for average industrial workers trailed far behind. Simultaneously, the agricultural sector had already entered a recession. Post-war overproduction led to crashing wheat prices, leaving rural farm families with declining incomes. This created a condition of corporate overproduction. Efficient factories were churning out more radios, cars, and appliances than a stagnant middle class could actually afford. To bridge the gap between production and purchasing power, the economy turned to a financial fix: installment buying. For the first time, consumers began purchasing high-cost goods with small down payments, borrowing against their future income. The roaring industrial economy was largely an illusion. Factories were producing inventory that consumers could only absorb by taking on highly vulnerable levels of household debt. With consumer demand propped up by credit, the massive profits accumulating at the top of the economy needed a new outlet. This capital bypassed fundamental business investment and flowed directly into financial speculation. This table illustrates the mechanics of margin buying. An investor could purchase stock by putting down only 10% of the purchase price. For a $100 share, the investor contributed $10 and borrowed the other $90 from a broker. The leverage here meant that a mere 10% decline in the stock's price would completely eliminate the investor's equity. If the price dropped, the broker would issue a margin call, demanding immediate cash the investor usually didn't have. This borrowed purchasing power drove a speculative expansion. The Dow Jones Industrial Average rose from 63 in 1921 to a peak of 381 points by September 1929. Psychological herd behavior took control of the market. Rapid trading and unrealistic expectations replaced any meaningful analysis of business fundamentals. The stock market had ceased to be a barometer of industrial health. It was a highly unstable asset bubble, inflated by borrowed money and extreme leverage. Beneath all this, consumer and margin debt set the foundational layer of the economy, the banking infrastructure. In the late 1920s, the U.S. banking system was fragmented into roughly 25,000 small, independent institutions. These banks lacked geographic diversification and held limited cash reserves. There were no systemic firewalls. Federal deposit insurance did not exist. If a bank failed, its depositors permanently lost their life savings, instantly removing that capital from the economy. Finally, the global economy was bound by the gold standard. While it created stable exchange rates, it severely restricted how governments could respond to a crisis. During a severe contraction, the gold standard prevents a central bank from expanding the money supply to provide liquidity and save failing banks. By late 1929, the economic machine was leveraged to its limit, saturated with inventory, and confined by the gold standard. A significant shock would now travel through every layer of the system. The shock arrived in late October. Confidence faltered, and panic selling struck Wall Street. On Black Tuesday alone, 16 million shares changed hands, destroying billions of dollars in paper wealth in a single day. The mechanical fallout was immediate. Plunging prices triggered mass margin calls that investors could not pay, forcing widespread loan defaults across the financial sector. The panic jumped from Wall Street to Main Street. As rumors spread about bad loans and bank losses, depositors rushed to their local institutions to withdraw their cash before the vaults were empty. Because banks only hold a small fraction of their deposits in actual currency, this sudden surge in withdrawals forced even stable banks into immediate insolvency. The crash functioned as the point of failure for the high levels of leverage built into the consumer and banking sectors over the previous decade. This initiated a deflationary death spiral. As banks failed, credit vanished, and consumer spending collapsed. Facing unsold inventories, businesses slashed production. Factory closures and layoffs pushed unemployment to 25%. Aggregate incomes fell, lowering spending further. Crashing prices increased debt burdens, sparking new bank failures. The macroeconomic failure translated into physical devastation. Millions faced malnutrition and homelessness, relying on breadlines and local charities just to survive the day. Policy decisions compounded the failure. The Federal Reserve allowed the money supply to contract, while international tariffs destroyed global trade, deepening the downturn. The collapse resulted from a collision of overproduction, wealth inequality, margin speculation, and a rigid monetary framework. The Great Depression teaches us that an economy cannot survive on industrial output and easy credit alone. Without structural firewalls, equitable income distribution, and monetary flexibility, even the most advanced economic system can fail.